What if I told you that getting your debt forgiven could end up costing you thousands of dollars in taxes? Today, we're unpacking a story that's a financial wake-up call for anyone with loans, especially if you're struggling to pay them back. By the end of this video, you'll know exactly why a written-off loan can trigger a big tax bill, what options someone in this situation might have, and how to avoid a nasty surprise from the IRS. Let's jump in. So, imagine your friend borrows $19,000. It's a big amount, maybe for education, medical bills, or just to get by. But life happens. He can only land minimum wage jobs, barely scraping together $10,000 a year. There's no way he's making those loan payments. Eventually, the lender gives up. They write off the loan, meaning, in their eyes, the debt is gone and your friend doesn't have to pay them back anymore. Sounds like good news, right? Not quite. Here's the twist. The IRS suddenly sends him a bill. He owes $3,000 in taxes. For someone making $10,000 a year, that's a crushing amount, almost a third of his yearly income. But why? It all comes down to something called cancellation of debt income. Let's break that down. When a lender forgives, cancels, or writes off a debt, the IRS treats that amount like income. In this case, the $19,000 your friend no longer has to repay is now considered money he earned, even though he never actually saw that cash in his bank account. It doesn't matter that he was struggling or that he never benefited from the money in a tangible way. As far as taxes go, canceled debt is the same as getting a paycheck. Every year, lenders file a special tax form called the 1099-C to let both you and the IRS know that a debt has been canceled. When the IRS sees that form, they expect you to pay income tax on the forgiven amount, unless you qualify for an exemption. This isn't a rare scenario. In fact, in 2022 alone, Americans had over $100 billion in debt canceled or written off by lenders, according to Federal Reserve data. That means millions of people could be facing surprise tax bills, just like your friend. Let's talk about why the IRS does this. Their logic is that if you borrowed money and don't have to pay it back, you gained a financial benefit, almost like you received a cash bonus. So they tax it as income. But here's where it gets complicated. Not everyone who has debt canceled actually has the cash to pay the tax bill. In your friend's case, he's barely getting by, which is why the IRS has some exceptions and exclusions built into the tax code. For example, if you're insolvent, meaning your total debts are greater than your total assets, you may not have to pay taxes on the canceled amount. There's also an exemption for debts discharged in bankruptcy, and special rules for certain types of loans like qualifying student loans or mortgage debt after a foreclosure. So, can your friend appeal the $3,000 IRS bill? In some cases, yes. The first step is to check if he was legally insolvent at the time his debt was canceled. If he was, he can file IRS Form 982 to claim the insolvency exception. He'll need proof, like a detailed list of his assets and debts on the day the loan was written off. It's worth noting, though, that this process can be tricky. The IRS doesn't just take your word for it. They want documentation. If your friend owned a car, a bit of cash, or any other assets, they'll be factored in. If his debts still outweighed his assets, he's got a shot at reducing or even eliminating that tax bill. But let's look at the bigger picture. This story highlights a critical issue in our financial system. Many Americans live paycheck to paycheck, and sometimes even a lifeline, like a canceled debt, comes with strings attached. Historically, cancellation of debt tax rules have been around for decades. They're designed to prevent people from gaming the system, borrowing money with no intention of repaying it, then just walking away tax-free. But the reality is, most people in this situation are not scammers. They're struggling. Often, the tax bill comes as a complete shock. There's also a policy debate here. Should canceled debt really count as income for people who are already unable to pay? Some lawmakers and consumer advocates have called for reform, especially for people with low incomes or overwhelming student loans. But for now, the law stands. If you or someone you know is facing canceled debt, what can you do? First, don't ignore any tax forms you receive, especially a 1099-C. Talk to a tax professional as soon as possible to see if you qualify for an exception. Even if you can't avoid the tax bill, you might be able to arrange a payment plan with the IRS. This situation is a reminder. Always read the fine print before taking out a loan and understand what could happen if you can't repay. And if you're struggling, know that you're not alone. There are resources out there to help. So, what do you think? Should canceled debt really be treated as taxable income? Have you or someone you know faced a similar tax surprise? Let's talk about it in the comments. If you found this video helpful, please hit like, subscribe, and share it with a friend who might need this info. Remember, financial rules can change, and how we handle debt and debt forgiveness could look very different in the future. Stay informed, stay empowered, and keep asking questions.